Most people think the biggest problem is running out of money. But what if the biggest retirement challenge is never feeling secure enough to actually use your retirement savings? This common retirement anxiety happens beneath the surface of retirement planning and has nothing to do with investment returns, retirement income, or how much you've saved. Instead, it has everything to do with how your brain interprets and responds to that money. Hey everyone, welcome back to the channel. Don't forget to hit the subscribe and like buttons. Your support means a lot to us and motivates us to continue creating the best retirement planning tips, personal finance advice, and retirement lifestyle content. Now, let's get started. Researchers like David Blanchett and Michael Finke have found something incredibly powerful. The way we label our money changes how we feel about it, and ultimately, how we use it. There was a story he told that really stuck with me. He said he was in a room with two of his business partners, and they had all just lost a very substantial amount of money. He turned to one of his business partners, and the man was angry. His face was red, and he was absolutely livid. As angry as anyone could possibly be. Then Tony turned to his other business partner and asked him how he was feeling. The man replied, "I'm peeved." At that moment, Tony said he actually laughed. Here's the interesting part. They all lost the exact same amount of money, but their emotional experiences of the loss were very different. And I think there's something very important in that. The words we use ultimately shape how we experience reality. And I don't think it's much of a stretch to say this also applies to our money and finances. The way we label our money influences how we use it, and this is exactly what we see in retirement. When you label money as income, it feels spendable. When you label it as assets, it feels like something that needs to be protected. Same dollars, completely different behavior. Once you understand that, you begin to realize that retirement is about the experience of money itself. Retirees are far more comfortable spending from Social Security, pensions, and annuities because those feel like a paycheck. But when it comes to spending from a portfolio, even if it provides the exact same income, they hesitate. They pull back. They second-guess their decisions. Many retirees are not overspending. On one hand, that's great news because nobody wants to run out of money. But on the other hand, what many are actually doing is underspending because money feels finite. Real spending tends to decline by about 1% to 2% per year in retirement. Much of this happens because people naturally simplify their lives as they age. We often develop a desire to spend less as we move into our 70s and 80s. Yet during our working years, when we're saving and investing, we often plan as if we'll spend the exact same amount every year forever. Now let's look at some real-world data. Let's look at withdrawals from actual retirement portfolios. The median withdrawal rate for married retirees is about 2.1%, while the median withdrawal rate for single retirees is about 1.9%. These withdrawal rates are well below what is generally considered a safe withdrawal rate. So if you're somewhere in this range, you can reasonably assume that your withdrawals could last indefinitely. And this points to an important psychological issue. Remember, we don't treat all money the same. We create invisible mental buckets. Income feels safe to spend. Principal feels untouchable. So even though your portfolio is meant to fund your life, you spent 30 or 40 years building it so you could achieve financial freedom. The moment you get there, your brain says, "Whoa, hold on, hands off, don't touch it." How unfair is that? From Daniel Kahneman's research, we know that losses hurt about twice as much as gains feel good. So now, think about what a withdrawal looks like. You log into your account and see your balance. Let's say it's $2 million, and you withdraw $80,000. Suddenly, that large top-line number goes down. That doesn't feel like spending. It feels like a loss. You've spent your entire life and career building up that number. Anytime you make a withdrawal from it, it feels like something has been taken away. It feels psychologically painful. Now, consider what happens if the market drops at the same time. You're experiencing a double loss, a market decline, and your withdrawal. As a result, people cut back, even when they don't want to and don't need to. Even if they're following a safe withdrawal strategy, and every part of their retirement plan says they're still okay to take the full withdrawal, many choose not to. They pull back because they don't want to add to the feeling of loss. Let's say someone has a $2 million portfolio and withdraws 4%, or $80,000 for the year. They see their balance decrease, and that decrease feels like, I just lost $80,000. Even though we know the remaining portfolio is still invested and likely to grow over time, and even though this withdrawal was planned and falls well within a safe withdrawal range. Now compare that to income. Imagine a retiree with no investments at all. Instead, they receive Social Security and a pension. Combined, those sources provide $6,700 per month. What do they see? A deposit. It feels like, I just earned $6,700 this month. I just earned $80,000 this year. The economics are the same, but the emotional experience is completely different. I started saving and investing aggressively at a very young age. I was fully committed to pursuing financial independence from my teenage years. By the time I graduated from college and landed my first real full-time job, I was earning about $50,000 per year. Within the first 10 years of my career, that income increased to around $70,000 annually. During that time, I continued saving very aggressively. My investments grew. I passed $100,000, then $500,000, and eventually crossed the seven-figure mark. Yet not once did I think about increasing my lifestyle. When I looked at my portfolio, I saw something that wasn't meant to be touched. Eventually, I advanced in my career and became a business owner. Fortunately, my income increased. Only then did I allow myself to upgrade my lifestyle. It didn't matter what was happening with my net worth or my investment accounts. I only increased my spending when my paycheck increased because that income felt dependable. And this is exactly the philosophy many retirees experience. It didn't matter what was happening inside my portfolio. I was never going to give myself permission to spend from it. I'm not saying that mindset was correct, but psychologically, it was true for me. However, once my income increased and I knew it was stable and reliable every month, I felt comfortable saying, okay, I can increase my lifestyle a little. I can give myself more freedom and more breathing room. I also want to be very clear about something. There is absolutely nothing wrong with improving your lifestyle as your income grows. As long as you're continuing to save and invest a meaningful portion of your income, you should enjoy the rewards of your hard work. Just make sure you maintain the discipline to keep saving and investing as well. But here's the challenge. By the time we reach retirement, the primary resource we rely on is our portfolio. That creates tension because we've spent decades training ourselves to protect it and preserve it at all costs. So how do we shift that mindset? For many people, that shift isn't natural. In some cases, it never fully happens. How do we take something we've been conditioned not to touch and transform it into something we feel comfortable using? How do we convert our portfolios into income? We don't want to unnecessarily restrict our lives or deny ourselves the joy this money was meant to provide. Ultimately, retirement isn't just about how much money you have. It's about how your money is structured and how you experience using it. We spend so much time focused on reaching a number, a net worth target, believing that once we get there, everything else will feel secure. But that number alone doesn't solve the problem because it's not the number itself that drives confidence in retirement. Rather, it's how your money shows up in your everyday life. That's why I would argue that we need to spend more time thinking about building a retirement paycheck system, not just a portfolio. When you turn assets into income, people tend to spend more confidently. They feel more secure in retirement. Quite frankly, they enjoy retirement more. The reality is that portfolio-only strategies don't usually fail mathematically, but they often fail emotionally. Again, people are generally not running out of money with these plans, but they are often not allowing themselves to fully use their money. They underspend, they feel anxious, and they hold back unnecessarily. Much of this comes down to an internal rule. I can't touch the principal. I've spent my entire life building it. So rather than using your money to support your life, it becomes something you protect at all costs. If you're someone who struggles with this, intentional design, and yes, sometimes working with a financial professional, can be incredibly valuable. Not because we're seeking complexity, but because it can give you permission to use what you've worked so hard to build. One of the most powerful shifts you can make is surprisingly simple. Set up a system that pays you a paycheck from your investments every month during retirement. Literally, structure it like a paycheck. Make it automatic and have it deposited directly into your checking account. Instead of constantly logging into your investment accounts and watching the balance fluctuate, make the withdrawal automatic. Then, the amount you choose appears consistently and predictably in your checking account. That can help give you permission to spend. And because it's automatic, it arrives every month regardless of what the market is doing. That consistency can provide a tremendous amount of peace of mind. It can shift your focus away from your account balances and toward actually enjoying your money. This also helps explain the appeal of annuities. This isn't a product pitch, but for some people, they provide a behavioral solution. You give a lump sum to an annuity company, and in return, they provide a regular monthly paycheck. For some retirees, this can be incredibly effective in reframing how they view their money and giving them permission to spend it. Earlier in my career, I wasn't a big fan of annuities. However, over time, my perspective has evolved. I certainly don't believe they're the right solution for everyone. In fact, no financial tool is right for every person. But for someone who genuinely struggles to spend from their portfolio and truly wants guaranteed income that arrives every month, annuities can be a valuable tool. Behaviorally, they check many of the boxes people are looking for in retirement. As always, we're not trying to optimize a plan only on paper. We're trying to build a plan that optimizes your experience of life. If a particular tool helps you accomplish that, it's worth considering. If it doesn't, that's perfectly fine too. Retirement is about maximizing your ability to actually use your money. One of the biggest risks in retirement is living as though you've already run out of it. So be careful how you label your money. Be mindful of the words you use, terms like portfolio, assets, and income, because they can have a significant impact on how you experience and spend money in retirement. What are your thoughts on language and how it influences behavior? I'd love to hear your perspective. Leave a comment below. I post new videos every week. If you got anything out of this one, please give it a like. If you're new here, consider subscribing. And if you know someone who might benefit from this type of content, please consider sharing it. I'll see you soon. Bye.